Right, good morning, ladies and gentlemen. Welcome back to Boutiques on Wednesdays. If you hear Christmas music, you must know that the year is running to a close very, very quickly. And I know there's a lot of us out there that wants to know how to position for this last couple of weeks and maybe going into 2026. Therefore, the BCI teams made for a wonderful lineup of some of the top fixed income managers in the country to look at SA fixed income, the current environment, and maybe what to expect for 2026. Joining us as moderator this morning is Roeloff Horne, Chief Investment Officer at Miton Optimal. Good morning, Roeloff. Really great to have you on our session this day and agreeing to moderate the session. How are you doing?
I'm good. It's lovely to hear the Christmas music and to realize that it's been a great year for all of us in the industry, and looking forward to entertain the audience in terms of the great panelists we have on the show today.
It's been a great year indeed after a couple of really, really dry years. And I know some of the stuff you're going to discuss this morning is to, what can clients more or less expect? Not that we've got a crystal ball. But Roeloff, before we get going, I mean, you've been managing client portfolios and solutions for intermediaries since 1998, not to give away your age. But I think the point rather to make is you come with a ton of experience and you know what to look for in portfolios through different market cycles. But before we get going, at Miton, I know you partner with intermediaries to assist them in managing client portfolios and various mandates, ranging from fixed income to global portfolios. But can you maybe just give us a brief background on the business and exactly what you do?
Thank you, Eugene. Thanks for the opportunity to be on the show today. First of all, Miton Optimal, we are manager-owned, and now, very importantly, 25 years we celebrate the business this year. 1998 is when I started in the international environment. So yes, Miton Optimal, our main objective is to provide our advisors with peace of mind. Peace of mind in terms of fund selection, investment process, and managing investment outcomes, using reporting skills to assist them to report to their clients, to report to our larger IFA networks on a regular basis, also to assist with succession planning using the wide variety of networks that we're dealing with. We're not vertically integrated. We are a specialist discretionary fund manager, but we are well positioned to assist advisors to find a new home should they look for succession through the process of our networks. We also pride ourselves that we manage, as a discretionary fund manager, model portfolios on a variety of local lists. There's almost no list that we don't have a model portfolio on. And then globally, the same thing. So managing global portfolios in dollars and sterling, even some euro portfolios, and then locally for income and growth, as well as growth portfolios that we're responsible for on platforms. And we have a long track record, and that speaks for itself through the business cycle. And therefore, as said, the aim is to provide our advisors with peace of mind.
Covering a lot of bases indeed when it comes to managing portfolios, not only from as a consulting point of view, but I think, all important reporting and execution, which is sometimes very challenging as well. But enough of that, Roeloff. Thank you so much for moderating a session this morning. Really great to have you on board. I'm going to hand over to you to introduce the panel and have fun.
Thank you, Eugene. We are extremely excited to introduce to you 4 incredibly good fixed interest managers, not just in experience, but also in really great returns over the last 1 and 3 years, even 5 years. Some of them had new funds launched, so don't have a 5-year track record, but all of them have experience over many, actually almost decades. But importantly, we're going to start with Melanie. She's co-responsible for the Granate BCI Multi-Income Fund, and then we're going to move to JP Duplessis, head of fixed interest at Methodical, in charge of the Methodical BCI Dynamic Income Fund. Moving on to Horne, CIO at Sasfin, soon to change the name. And then Sasfin Flexible Income he's responsible for, and then Philip Bradford as CIO of PortfolioMetrix, responsible for the PortfolioMetrix Dynamic Income Solution. Welcome to all of you. I'm excited to host you and actually quite honored.
Thanks, Roeloff.
Say hi to everybody.
Thank you, Roeloff.
Thanks, Roeloff.
I'm going to start my question aiming it at Mel, and this is very important for the audience to understand that Melanie, being co-responsible with Bronwyn Blood for the Granate BCI Multi-Income Fund, are focused in a more, shall I say, short duration type mandate. Steffi Plus One, I think, is the benchmark of that fund, and therefore a more, shall I say, cautious approach relative to JP, Arno, and Phil in terms of their mandates that they manage. So, and that's important, and this is what DFMs are supposed to do, is to assist the advisor to make these decisions. But my question, and this is the main question of the day, and if when we gave our feedback to all our financial advisors over the last couple of months, we said we are scared to be in the market, but also scared to be out of the market. And what's happened over the last 3 years, the SA bond market has rallied hard. 15% per annum, I think, is the number. SA property has rallied hard from April this year. Also good 3-year and 5-year numbers now. Fixed interest has been the game since 2014, if you ask me. You've been in a very good environment to manage fixed interest mandates, gents and lady. And I'm worried. Why am I worried? The bond market, the SA 10-year bond yield was north of 11%. Just in April this year, it's now 8.5%, I think, 10-year bond. So that meant a lot of, if you were in that market, which many of you were, and it's well done, you had a great rally behind you. The interest rates in South Africa is now cut. We've got a new inflation target. We can talk about that later. But repo rates now at 6.75, Steffi now at 7.15. Where to from here in terms of expectations within your fund for investors? And that includes us. Some of us, Miton Optimal have exposure to 3 and of the managers I'm talking today. So there are some conflicts here, but I think all of you can be proud. I want to share this. It's very, very important to share this, that each one of them have had a top decile a return over the last 3 years. I speak under correction, the Granate Multi-Income Fund, because of its low duration, first quartile, but not first decile. So top decile for JP's fund, Arno's fund, and Phil. So these guys are good. That PGA TV advert where they hit the ball so well and they say, these guys are good. The people you see right now are really good at what they do. But starting with you, Mel, where to from here in your fund in terms of generating Steffi Plus returns? Which asset classes are you excited about, and how are you going to manage the outcome from here? Taking a 12-month view. Over to you. You've got 5 minutes each, starting with you.
And the bell rings. Roeloff, thank you so much for that intro. And it's such an honor to be hosted by you today. So thank you. And thank you to BCI. So I think the best way to frame the answer to that question is to discuss what is happening in the fixed income market. What are the drivers of the environment of the market that we're looking to generate those returns from? And it's actually not that, it's quite a complex question to answer, because the way, we view the fixed income landscape, we've got not 1, not 2, but actually 3 structural forces that are playing out in South Africa. And if I just touch on each of those, I know I've only got 5 minutes, I'll do this really, really briefly. But the first structural reform is the one we've been talking about on these panels for a while now. It's the structural reforms that are going to lift the growth rate of the economy. So we all, we berate how we had the last decade of growth, which had so many implications for fixed income with much greater fiscal risks and compensation via yields. We know that structural reform recovery process is slow moving, but it's moving in the right direction. So those are those big structural economic growth reforms driven by Operation Vulandlela. And it fixes things like the energy sector, electricity, sorting Eskom out, sorting transmission out, logistics, water infrastructure, visas. They're now going to start to tackle some of the challenges in local government. That is long moving. we know we're going to get to the end of that journey when we reach at least 2% economic growth rate in South Africa. We're quite far away from that right now. We're just over 1%, and even better when we get to 3% over time. So that's been the backdrop that we've had for a while. But this year, we've had 2 additional drivers which have been introduced or have been moving towards the right place. The first one is the change in the inflation target. So coming into the year, we had an inflation target of 4.5%. So the Reserve Bank targets an inflation target range of, they had targeted 3 to 6. They had from about 2017 chosen 4.5% as their goal. So they wanted to target 4.5. Coming into this year, they started to float the idea in earnest that they wanted to target 3. And that's happened very, very quickly. So they came out at varying MPC meetings this year. They put 3% on the table. And then, as we know, in the medium-term budget policy statement from National Treasury recently, they've endorsed the new 3% inflation target. So what does that mean for us as fixed income managers? It means a lot of things, but it means 2 broad themes. Firstly, that the inflation risk premium that we would demand to be compensated for in our fixed income assets universe, which is a very broad universe, that is moving structurally lower. So from 4.5 towards 3, obviously it will take time for us to get there, but that's been a material structural change. And it's also opened up the door for a new interest rate cutting cycle. So coming into the year, most of us were thinking, well, we're bottom rates at round about 7. Now, clearly that door has been open for over time. As inflation moves lower, we can move significantly lower in the repo rate. So we're 6.75 now. Reserve Bank will be cautious. Maybe we can go into that later in the panel. But eventually their long-term forecasts are to get somewhere towards 5.5%. So that's a new theme that's been injected for us fixed income managers this year. And then the third component is this idea of fiscal consolidation. So we know as a country, we've had too much debt as a percentage of GDP, and that's just deteriorated and deteriorated as growth has underperformed, and we've spent too much. And for many years, the government was spending more in their budget than they were raising in revenue from taxes. So the whole mess was turned upside down. They've now corrected that maths. We are now raising more in revenue than we're spending if you exclude interest costs. And on that interest cost component, that was a key vulnerability that South Africa was carrying, that we, as a percentage of our revenue, we were spending too much of that on servicing the debt of the country. And it was something I know personally from my very recent experience of managing Africa bond portfolios, that is a key vulnerability which you need to focus on when thinking about sovereign risk or the credit risk premium that you demand from fixed income instruments. That is now stabilizing, and we expect that in the coming year, that debt to GDP peak will be reached and will move back down again, helped by the inflation target change, because that helps all the debt that's issued by the government benefits from a lower inflation. So if you take all of those things into the mix, that's a lot of moving parts in the backdrop. It affects all of the valuations of the asset classes that we look at within the fixed income market. The duration lever has been almost the easy one to pull. We've seen this big rally in nominal yields, but we still see pockets of risk premia that we find attractive across the universe. We do still need a risk premium because we haven't seen delivery. We're not at the end goal of any of these structural reforms, but we still see pockets in many areas of the market. Because we're a multi-asset income fund, we're targeting cash. Our benchmark is cash plus 1. We look to achieve cash plus 2% returns or STEFI plus 2, then we're happy. We have a very wide universe that we use to mine those returns. We like and trades. So for us, a happy place is if we can have good ideas in inflation-linked bonds and nominal bonds, good ideas in the fixed rate market and the floating rate market. And we can see still many opportunities in play. I know that I'm running out of time, so I'll pause there and hand over to one of the other panelists. But thank you, Roeloff.
Well done, Melody. So I think it's fair to say you have a wide variety of diversified securities, whether it's inflation linkers, nominals, some corporate, some global bond exposure, and some property I see as well. Very small, but it's there. So
yes, definitely diversification.
Yes, diversification is your answer, and in generating STEFI plus 2 net of fees, hopefully. So that's the message. Okay, 100%. Moving on to JP. JP, you guys are very brave. I see your benchmark in your portfolio is to outperform the all bond index. Very brave benchmark to target, and you've done extremely well. Well done over the last 3 years, and top decile performer. And the only remark I make is you have a reasonable amount of government bonds, and I see inflation-linked bonds and some cash in your fund. In answering the question, where to from here? In terms of generating, shall I say, a benchmark type performance, I think I'm almost scared to say it because it's going to be extremely hard to outperform the all bond index. But maybe you have the confidence to tell me different.
Okay, well, let me talk about the benchmark first, because we've actually just changed it to be cash plus 2. You must always have a benchmark that you can beat. So that's the fundamental rule of fund management.
You're brave and clever.
No, that's because we changed the structure of the dynamic. It was a bond fund. It was a pure bond fund, and we changed it to dynamic income fund a bit over a year ago, and that was to talk to a particular sector of the market. And I'm happy to talk about that and where it's positioned, and why I think it's a good allocation for kind of multi-asset funds and income funder funds, rather than like the widows and orphans fund that I run, which is the standard income fund. So that's I'm happy to talk about that. But maybe just before I do that, step back a bit and talk about where we sit in the world. First of all, thank you for making us all feel very old, that we've had decades of experience. I think it does. It does speak to, I think, the quality of boutique managers out there that my peers and myself are sitting on this panel. I think fairly, solid group of individuals with good experience. I have, in fact, less experience than everybody here on the panel in the South African market, because I spent the first 12 years of my career in global markets, managing fixed income in global markets, and then I returned to South Africa in 2009. That gives me, I think, a unique perspective on, firstly, the South African market, because it has lots of idiosyncrasies that are quite unique to this market, and I can bore you with that at some other time. But it also gives me a good insight into how global markets work, and what drives flows and pricing, etc., in global markets. I mean, a classic one, a sort of recent development has been the so-called Widowmaker trade, which was shorting JGBs back in my youth, and that's actually been the best trade of the year. So things can change globally. We are an open economy. We have a solid financial sector, but we are an open economy, and we are subject to the flows from global players, and we've seen those flows over the last year or so come into our market. But we do get tossed around a bit by those huge flows. So one always has to bear in mind what's going on in global markets, and in fact, a lot of the kind of positivity, without being too glass half empty, but I'm the fixed income guy. A lot of the positive things that we've seen in South Africa have been the result of kind of global context. When we think about the strength that we've seen in precious metals prices, the general disgust of global bond managers for their own bonds. You're hard pressed to find a US manager who's keen on US treasuries at the moment, and so they've all been piling into alternatives, and also looking at other parts of the world, like South Africa with our higher nominal yield. So that we benefited from that, but it's always worth bearing in mind that the punch bowl could be taken away at some point, and that they're not investing in South Africa because they like our wildlife or climate. They're doing it because they like our yields, and they are currently adverse to to the kind of fiscal positioning of their own governments, but that can change, and so we're benefiting. We're going through we've been through a good period, and we're going through a good period of returns as a result of that. It's also benefited us in terms of inflation. With strong currency has dampened inflation. I know we're going to talk about the inflation target in a bit more detail, but this is not aimed at the Reserve Bank. This is aimed at all. I'm taking on all central banks. It's a very dangerous thing for a fixed income person to do, but central banks, I think, somewhat overestimate their abilities to control inflation through interest rate policy. And I'll give you a good example of that, which is the US Fed, which has missed its target for almost 5 years now. And so we do give them, not to say they don't have influence, of course do, but their ability to sort of micromanage an inflation number is, I think, quite challenging. And I think the SARB may be, being a little bit overconfident. Overconfident is probably a nice way of putting it, about their ability to manage our inflation, to that 3% target. Yes, Roeloff, sorry. You're telling me to stop. I think we're going through a patch now of strong performance and relatively benign environment for our fixed income. But again, and we've against the backdrop that Melanie talked about supposed fiscal conservatism. We'll see how that plays out. And we manage money according to that context. But one has to be always aware that we are that these things can change, and having been in the market for decades, wary that environments can change fairly quickly. So I do have a lot of government debt in the portfolio, but I am de-risking somewhat as we see in these rallies.
So JP, in summary, to generate a positive return, what's your new benchmark again? Sorry, JP.
It's DFE plus 2.
So in generating that, you're going to be flexible, nimble, and tactical. Is that your answer?
Yeah. So the income, the widows and orphans, our Methodical Income Fund tends to be a lot more diversified, but a bit like what Mel was talking about, her fund. So lots of exposure to lots of different floating inflation, fixed government, longer term debt. Whereas the dynamic income will be a little bit more punchy, a little bit more volatile potentially with that, but a little bit more focused on the best opportunities at any given point in time.
Okay, thanks, JP. Moving on to Onno. Onno, being responsible for the Sasfin Flexible Income Fund, actually post Philip being responsible for it before you started. What was it, 2000? When did you join Sasfin as a CIO, Onno?
It wasn't 2000, unfortunately. So it was 2020. It was almost exactly to the day 5 years ago. Yeah.
Now,
you're thinking of my days at Coronation in 2000.
Yeah, and between the conflict of interest and all these things, it's fair to say Miton has held the Sasfin Flexible Income Fund in our morals for, I think, close to a decade now, in Philip's era and your era, and we remain happy investors for now, unless you guys surprise me with your outcome that you're going to share with us now. So I know, in terms of my question, I'm nervous. Bond yields have come down. Guys have done well. Everybody's happy. Clients are happy. Advisors are going back to clients who are reporting great returns. But where to from here in your fund from a Sasfin Flexible Income perspective?
Yeah, look, I think good investors are always nervous. I think that's one of the key things. When you start relaxing and becoming complacent, I think it's very easy then to lose sight of shifts within the market and ground swells that are changing and so forth. So, number one, I think it's good to be nervous. And obviously we've had good returns. So you do start saying, how much longer can this last? And I think what Melanie was really speaking to was the underlying drivers, which I concur with. in the sense of, we also think alike because we used to work together as well at some point in time. So I think the way that we've approached things within the Flexible Income Fund, it really is to sort of say there are 5 sources or 5 strategies that we tend to use within the fund. So there's obviously duration, there's roll down, there's credit, there's inflation linked exposure, and then there's also low volatility strategies as well. So those are really the 5 sources of return that drive the performance within the fund. And that it never stays constant. So we're always examining the market to say, what do we expect to be the key drivers of the market? So obviously over the last 12 odd months or so, since May last year, duration has been probably the single biggest contributor of performance within our fund. And for the time being, that probably will continue while these structural issues are still at play. I think the one thing I would probably add, over and above the fact that there are these 5 strategies that we tend to employ, is probably 2 things. The first one is, the use of credit in particular around the fund. So we've seen where credit spreads have gotten to, and there's a shortage of, let's call it, decent issuers in the South African market. And so again, there's a supply-demand disequilibrium, if you want to put it like that. And hence the fact that, in fact, almost globally as well, you see credit spreads are probably a lot lower at this point in the cycle than they ordinarily would have been. So, from a strategy perspective, we probably tended to shy away from using, going further down the risk spectrum as far as credit is concerned. So, that again can change in the future, and as markets will change as well. And then I think I'd like to overlay one further dynamic, which I think is probably going to influence us, even though it's not directly fixed income per se, which is that we probably live in an inherently disinflationary world. And there's probably 2 key things that I touch on. The one would be, if you think about China and its role in the sort of the trade war imbalances, and really sort of their solution to that would be to sort of redirect their manufacturing output to the rest of the world, and in particular around, from a disinflationary perspective, so cutting prices and so just to get the volume going through. So I think that's one underlying dynamic around this disinflationary period. And then the other one, which is this life-changing thing that we're going through, which is really the rise of AI and where it takes us to. So when we think about it, the way that we're thinking about it is the K-shaped economy, which is, the 2 sort of angles of the K, one pointing up and the other one going down. And that speaks to rising inequality as well. So there's a whole bunch of issues that we're going to have to touch on over the next 15, 20 years. But the top end is really the digital economy, which is cash flush, as we know, and, the data center sort of infrastructure rollout, the numbers are just staggering in terms of the amount of money that's going to that and the energy that's going to be required. So that segment of the economy, the upward sloping one, is going to drag the rest of, let's call it, the non-digital economy with it as well. But the problem is going to be around employment numbers. So you're already seeing some of this happening at the moment. So I think that's an inherently disinflationary type of environment. And obviously that's then going to be good from a rate cutting perspective globally, in particular the Fed, and then obviously from a fixed income perspective. So then it speaks to what Melanie was talking about, is a reduction in your inflation risk premiums as well. And so I think from a fixed income perspective, I think we're in a sweet spot. We have to accomplish some of those structural issues. And all things being equal, we should be able to get there because it is a positive supporting environment. Our politicians just have to deliver on some of the structural side of things. And of course, as you say, we should still be nervous and worried about some of those tail risks. So I think that's really where we sort of getting to.
Thanks, Arno. And in terms of your fund, in the short term, any ideas or a change that you foresee yourself actioning?
Yeah, I think, obviously duration has been one of the key drivers, as I mentioned earlier. We are still in this positive environment, and what we're seeing really is a lack of bad news. And when you're in that sort of environment, it tends to grind lower. So unless there's something that comes up which takes away from that, let's call it the inherently disinflationary type environment, and there's, we've been around long enough to know that these things do happen, in terms of either credit events or a liquidity event or a risk-off type event. Sure, those are there, but the structural story is still in play at the moment. So we're looking at, when we do our modeling, we're still looking at returns, across the sort of the maturity spectrum, still approaching, as a base case, still approaching double digits returns over the next 12 months.
Oh, I was going to ask you, and you went there. So double digits, you still think it's possible based on your mandate and your opportunity set?
Yes.
Thanks. Okay. Double digits means 10 and more.
Right.
So 10.1 is good then. Okay, moving on to Phil. Yes, I can only say that Philip has been very successful in identifying opportunities in this fixed interest market with a more aggressive mandate, in my opinion. But he will maybe differ from me in that respect. But maybe it's just the way that PortfolioMetrix, Phil, and his team are managing assets. So please respond to that one, Philip.
Thanks, Roeloff. And every time you put up your finger earlier, I thought you were saying there's a wicket in the cricket in the background. I got excited every time. I didn't realize you were saying it was 1 minute left.
Anybody's welcome to update us.
Yeah. Firstly, by the way, I want to correct you that the last decade's been a terrible time for South African bonds. I started running this mandate back over a decade ago. Bond yields were 8.5, the Orbi. They're now 9.5. So and understand. So they're a lot higher than they were back then. So, and the starting yield is your most important thing with fixed income instruments. So, I think importantly as well as I would definitely resist the aggressive tag. It's actually about being more dynamic, as we kind of say, because the opportunity set is very, very broad for us as fixed income investors. And we can use terms like duration and convexity and credit and the likes at the end of the day. We are looking for the best interest rates that are available for investors. The last decade, we've had an environment where interest rates were actually lower and things got really, really terrible. The last 5 years, even 2022 was a terrible year. 2023 was a terrible year. It's only since the GNU that things have sort of improved a bit. But we've actually gone from that, we've been downgraded to junk. We've gone from the A team to the B team to the C team to the D team to the E team. And now we've been pushed back to the D team. So the only real reason to get negative on South African bonds right now and the fixed rates that we can still get is because they've done really well. We are still today getting, in the dynamic income fund, our yield is about 10%. Okay, so just under 10%. That means inflation plus 6.5. That means cash plus sort of 3.5. With interest rates falling, with inflation target coming down, what do you want to do? You want to lock your interest rates at the higher levels. And then you've got to ask, well, why are longer dated bonds still giving us 9.6% in South Africa when we think inflation is going to be closer to 3%, and interest rates will probably come down to 6%, repo rate will probably come down another 0.5% next year. And that is simply because the South African environment has improved, but it hasn't improved that much yet. So we've gone from very bad to bad, and things are moving in the right direction. And the important thing to really understand from a fixed income investor is don't be scared of the volatility, particularly in something like government bonds, because they are still the safest from a credit perspective. And if you want to get good interest rates from here, the volatility tells you that they price a lot. And the paradox in the South African market is that your most risky bonds, your highest risk credit bonds, don't price every day. So they've got no volatility until something goes wrong. And the assets that price the most, that have the most capital volatility, are the least risky from a credit perspective. So the bottom line is, from here, the current yield of just under 10%, that tells you, all else equal, what your return's roughly going to be, plus or minus a little bit around that. And with inflation coming down close to 3%, I have my mom invested in this portfolio with her retirement income. She needs an income of, let's say, 4 or 5%, okay, plus a bit of inflation type risk around that. If I can get her closer to 10% return, that is more than we're expecting from the equity market. So right now, the rates we can still get today, even though things have improved a lot, we are still locking in inflation plus 6 in the long end. And over time, you would only really expect bonds to give you 1.5% to 2% above cash. So if we can still lock in yields higher than that, it's definitely something where it's very hard to make an argument that bonds are expensive at this point in time. So the forward returns are, ironically, the outlook is actually better than it was a decade ago.
Philip, I certainly suffer from equity fatigue because our portfolios were exposed to fixed interest over the last 10 years, and it's been a good place to be. So maybe that's my perspective. So apologies for making that statement. But the reality is it's been, for most living annuity investors, conservative investors, it's been a good time over the last 10 years through the cycle. And well done to you all. If I can move on to certain topics. First of all, it appears from everything that you said that inflation's less of a problem, and Horne went into this inflationary environment, and I agree with him from a philosophy perspective. But what worries me is that there's always some risk out there, and that can surprise us on the downside. Now, specifically, JP as well as Mel do use inflation-linked bonds in your portfolios at the moment. Can you quickly, in a minute, explain why you use inflation-linked bonds in your portfolio, Mel, and then moving on to JP?
Yes, thank you, Roeloff. So it's part of our universe. It doesn't have to be in the portfolio if it doesn't make sense on a relative basis. But we do think that linkers, we have been adding to linkers this year for a couple of reasons. When we look at linkers, sorry if this sounds very academic, but we've got a couple of thresholds we need to meet to include linkers. If you can get real yields of 4 to 5% on a linker, it makes sense in any income fund world that you would want to, but obviously it's a relative game. So we have to look at relative to other asset classes. Why have we liked inflation-linked bonds this year? And we've been adding to exposures because yields have been rising. So close to 5% real yield on linkers makes sense to us in many worlds in the income fund world because it gives you diversification, yes, but it also gives you protection. So it's really cheap insurance to have in the portfolio. The real yield has to be attractive, and then the break-even inflation. So the difference between what you're getting on inflation-linked linkers and fixed-rate bonds also shouldn't be too challenging. Otherwise, you should just buy the fixed rate bond. So we found pockets of value across the linker curve out to sort of the 7 to 8 to 9 year, which makes complete sense to us on a relative basis. In addition to that, we think those real yields, so apart from just giving you can sleep at night knowing that you're going to get the real yield, doesn't matter what inflation does. We think those real yields are too high. So we mentioned pockets of value where re-rating hasn't happened yet in the market. We've seen nominal bonds rally, so a lot of that re-rating has come through. But as we move to a lower inflation world and a better fiscal risk world, where our creditworthiness of our government slowly improves over time, those yields are too high. Those will fall, and you'll get a very nice capital return out of that aspect of the market as well. So there are many reasons why we would include linkers, quite dependent on the real yield that's on offer, and we're quite selective in terms of where we're positioned across the curve. I tried to do that quickly for you, Roeloff.
JP, anything you want to add to that,
yeah, I mean, I think for me, it's a similar picture. I think you are getting attractive real yields. Obviously, not as attractive as the nominal yields have been, but again, it gives you protection from any change in the inflation outlook. If inflation does come under control, then there's going to be a lot of pressure on the SARB to reduce interest rates. Because they've said that that was part and parcel of reducing their inflation target. So, and that'll reduce the kind of gap between nominal rates and inflation over time. And I'm mostly invested in the kind of shorter end of the inflation linked bond curve, where the break evens are attractive. So it makes sense. It's a good place to be. And if we do see, if we do see inflation pick up, they benefit. If inflation is under control, then I think the SARB, cuts rates and keeps that gap between repo and inflation, tighter.
Thanks, JP. Horne, do you have any inflation linkers in your portfolios at the moment?
Yeah, we also do have as well. And again, I think it's also very much an insurance sort of approach to it. So, I like the framework of Nassim Taleb, which is that anti-fragility. So when you're looking for, it's the same reason why, a lot of people say you should have a little bit of gold in your overall portfolio, because if something goes wrong. I think so when something goes wrong, what have you got that can basically mitigate the effects of that? So linkers for a fixed income portfolio manager is very much that anti-fragile asset, which is that it's really about looking at the tail risks if there's some big inflation shock. But on their own, as they stand, they do represent fairly good value. Probably there's one aspect to them which is probably less appealing, I suppose, in a sense, which is their liquidity. So if you sort of really want to shift large volumes at any point in time, there can be times when it's not as easy. But again, we're not trying to trade them per se in terms of, buying them at a real yield of 5 and then selling them at 4.75. It's not that sort of approach. It's very much around, looking at what the risks are and does it form part of an overall or of an overarching strategy that makes sense in our funds. In terms of mentioning what we don't have, for example, is we don't have exposure to property or to any equity risk or currency risk. And I think what we try to deliver in the fund, it really is a quite clean fixed income solution in that respect. So, linkers definitely form part of that, as an addendum, I suppose, to this structural shift that we have where duration has been the key driver.
Thanks, Arno. Phil, your view on SA inflation linkers?
Yeah, so I'll be a bit more controversial then. I think if you're going to compare inflation linkers to maybe money market instruments, you can say, okay, if I'm getting a 4.5% yield out of an inflation linker plus inflation, then okay, plus let's say inflation's 3, then okay, maybe I'm getting 7.5. That's not too bad going forward if we're expecting interest rates to be 6. But if you can lock in 2% more than that in a fixed rate bond, then you're going to get 2% more. So the simple thing here is in a falling inflation environment, the last thing I want is inflation linkers. The other thing to understand with inflation linkers as well is why have they underperformed cash by 1% a year over the last decade? And the simple thing is this, is that in an environment, if we have a big sell-off in fixed rate bonds, the rand blows out everything today, your longer dated inflation linkers will sell off as well. That the assumption that, inflation spikes today, inflation linkers are going to go up, but the exact opposite happens. We find where a better combination is floating rate instruments. So in other words, variable rate instruments that benefit from rates going up. Combining that with the fixed rate instruments actually gives us a better risk adjusted return. So if we're holding inflation linkers today and there's a big inflation spike tomorrow, they're not going to protect the capital is going to fall. That's just how they work globally. And we've seen that happen throughout the big inflation spikes. So we find that inflation linkers, if you're in the money market type space and you're comparing to cash instruments and a falling rate environment, they should do better. But we honestly think we'll probably get 2% more out of the fixed rate bonds per year. So we don't hold any inflation linkers in the portfolio right now.
Well, if I can challenge you on that one, if you have a situation where we have foreign investors fleeing South Africa for whatever the reason may be, as far as I understand, they almost do not hold a single SA inflation-linked bond in terms of their exposure, but they do hold fixed rate and nominal bonds in South Africa. Don't you think there's a risk of just having a bit of shall I say, tail risk in not having inflation linkers in that environment?
I'd rather have the government floating rate bonds in that environment. So what happens is that in an environment, if bond yields, let's say, go from 9.5% to 10.5% in a sell-off, the relative attractiveness of inflation linkers gets hurt, and they sell off as well. So let me give you a simple example. If you go back to 2022, when you had the big inflation spike around the world after the Ukraine invasion, UK inflation linkers fell by 50%. The capital, they fell by more than the fixed rate bonds. So the point is, inflation linkers are a lot more expensive relative than fixed rate bonds right now. The yields are lower. They are much lower because insurance companies, banks, everyone else has to hold them because they're an attractive asset if you're trying to hedge against inflation. But they are still giving you 1 or 2% less than you probably need out of them to make them relatively to make them more attractive than a fixed rate bond. So on a 10-year basis from here, what's your view on inflation? If your view on inflation is 3 or 3.5, then you got to say, well, okay, if I'm buying an inflation linker on a yield of 4, then I'm going to get 7.5 return, maybe 8 if I'm very lucky, if there's a bit of an appreciation. If I can buy a fixed rate bond at 9.5 right now, in that lower inflation rate environment, that fixed rate bond is going to be more and more attractive every day. So if we want to protect against something going wrong in South Africa, we want to hold floating rate instruments. In other words, variable rate or money market type instruments, because those don't fall. In a sell-off environment, inflation-linked bonds will sell off.
Phil, thanks. Anybody else? Mel, JP, Arnold, challenge Phil on that?
I'll take that. I think we're talking slightly across purposes here, because when we talk about inflation-linked bonds, we're not talking about the CILI, which is the index, which has extremely long-dated and a lot of duration in it. We're looking more at the short end of the curve. So we're starting to go into very technical fixed income land here. But the reality is that because of the structure of inflation-linked bonds, they have lower coupons because their coupons are real coupons. And as a result, they have the cash flows of the maturity is also compounded by inflation. So the cash flows of inflation-linked bonds are very backdated versus nominal bonds, and so they tend to have very high duration, and as a result do move a lot with the market. But we're talking specifically about the front end of the curve. And if you do see an exit by foreign investors, you're going to see big flows out of. So I'm not predicting this. I'm just saying if it does happen, you're going to see big flows out of South Africa. The rand will probably take some pain. Inflation will spike, and the short-dated linkers will perform well relative to the sort of easy make an extra 2% in nominal bonds. I think that's a little bit of just a bit more color on that.
Okay, I'm going to stop the conversation here because I think it just tells you that that's why there's a market. Views are different, and therefore that creates a market. Thanks for that feedback. The next topic is SA property. First of all, just a question. Between you, Phil, and Arno specifically, and JP, are you allowed to invest in property within your fund mandate at the moment?
So from a category perspective, the multi-asset income category allows a property, and it allows equity up to 10%. But we don't buy any property. Listed property stocks are equity. You're buying the shares of a company. As in buying shares of Anglo American or Naspers or something. So we don't hold any of that. We've said, listen, we're trying to generate the best interest rate possible, and we don't want to take on any foreign exchange type of currency volatility either. So I firmly believe that this concept that property is like a quasi bond type asset has been disproven massively. I was having a look the other day. Growth Point as a share. I remember it being $30 over a decade ago, and I think it's now about $15 or $16. So the point is that's equity. We don't even lend currently money to the in other words, buy the bonds of the property company. So no, we don't hold any property, and we don't hold any equity exposure.
Thanks for that, Phil. I'll move on to Arno then. Are you allowed to hold property, equity, or are you? What's your view on holding it in your fund?
Yeah, I think it has its place, but not in this fund. As I said earlier, we try to deliver a clean fixed income product and solution. So it excludes any of the equity risk that Phil sort of touched on, and any currency risk. I mean, ultimately, what we're trying to do is deliver a low volatility income solution. And as soon as you start adding in property or equity risks of any sort or currency exposures, you're just adding volatility drivers to your sort of proposition. So it has its place, and certainly I'm not saying that using property within an income producing sort of fund is wrong, but certainly the way we're trying to approach it is a much cleaner approach to that. I think it has its time and place. Yeah.
Thanks, Arno. JP, you want to add on to that? Because I'm going to feature.
I don't have property in the portfolio. I mean, I think similar to the other two, I see property as quite a high hurdle rate for. So again, I would never say no to anything. If property dividend yields were 40%, and completely bombed out, then then obviously there would be scope for it. But you are introducing quite a lot of volatility into the portfolio, or the portfolios potentially, and it does. Also it's quite an illiquid market, and tends to be flung around quite substantially by flows. So steer clear in general markets unless there's kind of a real big dislocation of the property market.
Thanks, JP. Thanks, all three of you. You've just promoted why advisors should use a DFM, because we use property as a building block in most of our solutions, not all of our solutions, but most. And therefore, use your DFM to add your property allocation next to these wonderful good managers. Mel, I'm going to give you a credit here. Granate's been absolutely successful in actually getting into the property equity space globally and locally over the last, 3-4 years. And I know you hold some property exposure within your fund. Your conviction in having, call it 3.5% in your fund?
I have sympathy with everything that has been said so far in this panel. I've run funds that have included property over many, many cycles. So going all the way back to Arno when I started out with you all that time ago. So property definitely moves through cycles. I mean, there's no question about that. There are times that it introduces great volatility into your return profile, and we've learned exactly what that looks like and feels like over time. So I have a lot of sympathy about not wanting to have a tail that wags the dog in terms of income fund portfolios. So we would always keep the exposure small. So that's point of departure number one. Number two is that, at Granate, we run our process quite slightly different to what I've ever done before. We have this idea of it's one investment team. We have one investment committee that sits every Friday and more regularly that looks for different types of cash flow streams, and then we're best to represent them. And there are defensive, selective counters within the listed property market that do provide us with that. They provide us with income-like returns. And not to lean on the strengths of the team when we can find cash flows that are defensive, predictable, inflation-beating, also feels like it's unnecessary to exclude them from a return profile. But where we do make adjustments with our income fund hat on, is we're looking for diversification, yes, but we're looking for defensive income streams. So if we don't meet the hurdle of a defensive, predictable, inflation-beating income stream, there's no reason for us to hold it at all. So it's not a default position in any way, shape, or form. And there'll be times we don't have any listed property. When we are at a point of in the cycle where there are opportunities on the table, and we can look in different jurisdictions for that, we certainly want to be able to take advantage of that. We do keep it small, though, so I don't want to over-elaborate the importance of listed property within our asset allocation process.
Thanks, Mel. Moving to global, and now I think it goes by hand up and talk. We've got a situation in the global, call it long duration bond market. France, Germany as examples where rates are actually spiking up. The US is actually going the contrary. I think the 10-year bond's now at 4%, moving from 4.5%. A lot of different fiscal agendas across the world, whether it's due to protectionism, whether it's due to ill discipline, whether it's due to leaders or GNU or coalition governments. There's a lot going on in the global fixed interest markets. How does it affect us? Who wants to go first? Mel, you can't because you just spoke. So sorry. JP's going to go first.
Sorry, Mel. I hope I didn't steal your thunder here. It affects us. It affects us from, as I spoke to earlier. It affects us from the attractiveness of our bonds and the flows into our bonds. There's been a lot of studies looking at our long end and long ends of other developed world bond markets, and a lot of those are influenced by a lot of our long end is influenced by them. I think what we're seeing now is as I mentioned, the Japanese trade. What we're seeing is a change in the environment where we saw an abundance of Eastern saving, whether that was Chinese or Japanese. The Japanese really started it first. Chinese came came later, and the recycling of those savings into developed world government debt markets. And we're seeing a slow unwind of that, where a lot of these bond markets got kind of drunk on the liquidity of the savings flows. And we got to the point where in 2022 we had a big fallout in those government bonds, but that came from really incredibly low levels of bond yields. So we have been through a period of, say, 30 years where yields were distorted by those flows, and valuations didn't really play any part in government bond yields. But that is changing now, and we sort of getting to where valuations matter again. I don't know if that's a slogan, but and that will have an impact on developed bond markets, and as a result, ours. It doesn't feel like that at the moment, but over time, that will probably put some pressure on the longer end of our curve, all else being equal, obviously.
Thanks, JP. Mel, I'm going to give you the chance now. You had your hand first up, so you can go.
I did. Phil, I'll keep it really short because I know you want to add some things as well. So, I would just say that we're in a phase right now where developed markets are behaving badly. And high debt levels, they matter because they make you vulnerable to fiscal news. I mean, if we've learned anything as fixed income managers in South Africa over the past 2.5 decades, it's been that high debt levels have repercussions and implications, not all the time, but certainly make you vulnerable to fiscal news. And we can see that in the US, Liberation Day, higher yields and a weaker currency at the same time. We saw that in the UK, higher sterling, weaker sterling, higher yields. That's very much the type of EM behavior that we're used to. We're seeing it now in Japan. We saw some of that in France with fiscal vulnerability. So from a relative basis, people would look to diversify outside of those badly behaving markets into ones with more orthodox policies. And South Africa just happens to be one of those right now. So we certainly have a hook within the EM space, which is very constructive when we're thinking about valuations and foreigners coming back into this market. I'll pause there. Thanks.
Thanks, Mel. Phil, you want to add?
Yeah, I think it's really important to understand what drives bond markets, and South we can teach the rest of the world about what not to do over the last sort of 10, 15 years. Our bond yields used to be 6.5 back in 2012 odd times, and our debt to GDP was 40% and even lower than that. But as you started letting wasteful expenditure, borrowing too much, what happens is your bond yields go up. It's your cost of borrowing goes up. And what actually has happened, what we saw with South Africa when bond yields went from 6.5 to 12, even 13 in the long end, that was because we were spending too much and borrowing too much, and we were wasting our expenditure. And that's what you're kind of seeing starting to happen in Europe, where they go, we're going to have to spend more on defense, et cetera, et cetera. However, though, what affects South African bonds the most? Your shorter dated bonds are mostly impacted. So let's say like 2-year, 3-year, 5-year rates in South Africa are mostly impacted by inflation, local interest rates, and then US interest rates, and even out to their sort of 5 and 10-year rates. However, though, once you go to the longer end of our bond curve, a 20, 30-year bond, you're more worried about debt to GDP fiscal risk. That's why you're getting an extra 3.5% yield there. It's not because of US rates and inflation in South Africa. And the same applies to the rest of the world. So what you've got to watch out for when you look at Japan or you look at Germany or you look at Europe, is saying, okay, well, if their long-dated bond yields have got higher, that's because your 20, 30-year view of them, you're worrying about them borrowing too much now. So what do we need to worry about? We're still in an environment where interest rates are falling and are likely to come down, particularly in the US, which is helping us. Okay, if there's a big spike environment in interest rates around the world, that will maybe be negative for us. But right now, the environment is still positive. Falling rates global allows us to cut rates a bit more locally. So that's why we still want to be holding these fixed sort of yields at these sort of levels, because they are not pricing in those massive rate cuts yet. So as much as we're worried about things going on around the world, and someone's going to do something stupid in the next 12 months, we're virtually guaranteed of that. But we're positioned right now with more than enough in cash in other assets to be protected from the sell-off. but then also to take advantage of that, because that's what you need to. When those big sell-offs happen and we can get bond yields back, we were buying bond yields at 12% a few months ago in April. If it goes back there, we want to be buying again. So we've built up cash to be able to do that. So you need to be positioned. You can't just be positioned, oh, I'm only in fixed rate bonds, rates are going to come down. We've got probably half of the portfolio that's benefiting from that. But in an environment, if something does go wrong in the world, we need to take advantage of that. And that's how we all build our portfolios.
Thanks, Phil. Horne, I'm going to finish with you, but basically have an hour, but we've done an hour, but I want one more minute for you to take on a quote that Phil mentioned earlier. He mentioned the no volatility in certain corporate credit issuance within our market, where certain fixed interest managers hold that, and it looks like they have a brilliant Sharpe ratio, and therefore, good stable returns. And that's what Phil referred to earlier. Do you agree with that statement, that there's potentially some things that maybe as an advisor or even as a fund selector like ourselves, we may miss in terms of a fixed income fund that we are holding or looking at, number one? And do you think there's any risks for the industry in that respect? A, and then B, the inflation target. How realistic is that? So see if you can do that in a minute.
Yeah. Look, the low volatility strategy is definitely, it should be, core to, any fixed income manager in the space, if I can put it like that. And I will sort of say, you said I wanted to take him on, but it's not that. But I'll just sort of say, well, look, the biggest investor in our low volatility fund is in fact PMX. So I think they have confidence in our ability to manage low volatility solutions. Yes, it's core to any income solution. And then on the inflation target, I think for the people who are listening, I think the implications of a 3% inflation target are quite profound. If we get there, let's put it like that, which is that, you then have to start thinking about when you purchase annuities, where are you in the cycle? Where are interest rates? What are the possibilities? So certainly high interest rates are a good place to be when you want to retire and you want to sort of buy annuities, whatever the case might be. So certainly thinking those things through, I think in terms of the actual longer term implications are quite profound. And I don't think we're quite there yet. But certainly, I would concur with what Phil said about, if there was some sort of event which pushed yields up, to closer to the levels that we saw, we would also be buying there as well.
Thanks, Horne. Thank you, JP, Mel, Phil, Horne, for an exciting session. And it's really clear how you think about South African fixed interest and that the opportunities are still there. I'm less worried. I'm not so scared to be out. And I think from a positive perspective, other than you guys are all champions in what you do over many years, South Africa did beat India, according to some feedback I got online here. So let's celebrate another win for not just asset classes, not just fixed interest, but for cricket and rugby as well. And what a year we've had. So thank you, BCI and the team, Olga, Tanya, Eugene, for this opportunity. I'll hand over to you.
Roeloff, thank you very much indeed for making very interesting conversation. And to the team, gentlemen and lady, Melanie, thank you so much for joining us this morning. It's been absolutely insightful. And I'm going to echo your sentiment. It's truly a top panel that we had this morning. And thank you for the wonderful work and all your contribution you've done for our clients during the year. Looking forward of lots more engagements in 2026. To our audience, this is not our last session for the year. Tomorrow morning, just a quick reminder, we've got our Fundrock Hedge Fund webinar. I've seen there was a comment from one of the audience members saying, maybe we should look at hedge funds. Hedge funds, very interesting. It's not necessarily the magic wand that everybody think it is, or maybe it is. And that's why we're having these discussions on hedge funds to try and find out where it fits into client portfolios. And then our last session will be the 3rd of December, where the Apex Investment Consulting team will unpack some of the investment ideas that worked during 2025 and some that maybe didn't work as well. and what to look for going into 2026 and how to structure client portfolios. Thank you all for joining us this morning. It's been absolutely wonderful. We've had a big attendance this morning. Thank you for your continued contribution. Looking forward in seeing you tomorrow or then next week, Wednesday. Again, to our team this morning, thank you so much. It's been absolutely great.